Welcome to Portfolio Playbook. I'm Dominic Dantes, Portfolio Manager and Founder at Dantes Outlook. And here's what came across my desk this week. Market breadth has been impressive. In recent sessions, advancers, or the number of rising stocks on the NYSE, has outpaced the number of declining stocks by about 4 to 1. That's according to Sentiment Trader. Historically, improving breadth signals like this suggest the uptrend in equities can persist, even if gains slow from here. On the macro front, Deep Macro has noted that inflation pressures are still homegrown in the US, not just tariff-driven, and they expect the Fed to stay cautious on rate cuts. Their models also favor the US dollar on relative growth strength, particularly against currencies like the British pound and the Canadian dollar. At Dantes Outlook, we've trimmed our active tilts, which has added to portfolio excess returns this month. We maintain a preference for US equities while selectively adding to emerging market equities. To fund that, we've taken profits in gold and some of our inflation hedges. On the tactical side, we've introduced a strategy, an absolute return strategy, focused on US tech sector for now, especially within semiconductors. Using these momentum signals, we target ETFs that have historically sustained breakouts in price terms globally, aiming to capture high reward to risk opportunities only when the market environment favors them. And here's some research to consider. Beyond this near-term positioning, there are some structural shifts worth noting. One is in corporate bonds. Barclays reported that portfolio trading volumes have surged about 54% in the first half of this year, 2025, hitting a record of $823 billion. That's made credit trading look more like equities, faster, larger, and more liquid than in years past. For investors, this means that credit markets may be more resilient and efficient, even in volatile conditions, which makes them an interesting portfolio addition during this time. Investor behavior is another theme I'm watching. Morningstar's latest Mind the Gap study shows the average dollar invested in US funds earned 7% annually over the past decade. But that's about a 1.2 percentage point difference below the fund's actual returns. This gap reflects performance chasing and poorly timed trades. So it's a reminder that consistency and discipline often matter more than timing the next big move. That's why we remain disciplined. We're not creating trading accounts. We're creating portfolios that stand the test of a trend. Finally, Fidelity strategist Denise Chisholm, a former colleague of mine, highlights how markets often price in reality before government data catches up. That's why we rely on market signals more so than forecasting the economy. A recent example is that one of the largest downward payroll revisions in history occurred this week. Historically, those kinds of revisions happen near recessions, but by the time they are reported, equities may have already seen the worst. In fact, forward returns after these episodes have often been surprisingly strong. That's all for now. Have a great week.